It didn't begin with panic. It didn't begin with a collapse. While markets celebrated rallies, while confidence felt routine, while investors watched familiar charts, something far more important was shifting quietly. Not in New York, not in London, but in Tokyo. A market most people consider boring just sent a signal powerful enough to pull liquidity out of the entire global system. When the anchor of cheap money moves, everything tied to it begins to drift, capital reverses, leverage tightens, and what looks stable today can become fragile tomorrow. The real danger is not what people see, it's what they don't notice until it's too late. Welcome to Boring Currency Reports. If you've lived long enough to watch cycles repeat, if experience matters more to you than noise, then subscribing here isn't about excitement, it's about awareness. And before we begin, tell us in the comments, where in the world are you watching from? For years, the global economy followed a pattern that felt dependable. Growth slowed, central banks responded, liquidity increased, and markets recovered. Over time, this cycle trained investors to believe stability was permanent. Risk felt controlled. Volatility felt temporary. The system appeared resilient, but beneath that surface, pressure was building in a place few were watching carefully: Japan. Japan rarely commands attention in global financial conversations. Its economy grows slowly. Its population is aging. Its stock market does not dominate headlines. Yet Japan holds a position of unusual importance. For decades, it served as the world's anchor for low interest rates. While other economies raised and lowered rates, Japan stayed near zero. That stability shaped global behavior. Cheap borrowing in Japan allowed capital to flow outward for years. Japanese money moved into foreign bonds, stocks, real estate, and financial products across the world. This flow was not speculative, it was structural. It became part of how global markets functioned. At the center of this system sat the Japanese government bond market. These bonds were more than domestic debt. They were a signal. As long as yields stayed low, markets assumed cheap money would remain available somewhere. Investors, institutions, and policymakers built decisions around that assumption. Over time, it stopped being questioned. That is why recent changes matter. Long-term Japanese bond yields began to rise. Not only short-term rates, but 20-year, 30-year, even 40-year bonds. These instruments are held by long-term institutions that value stability over speculation. When yields at this end of the curve move higher, it signals something deeper than normal volatility. It signals a break in structure. Japan does not shift abruptly. Its financial system is designed for control and predictability. For years, the central bank actively suppressed yields through large bond purchases. This policy created confidence, but it also created dependence. Markets learned to assume intervention would always be there. When yields rise despite that framework, it suggests limits are being tested. Higher yields mean lower bond prices. Lower bond prices weaken balance sheets. Japanese pensions, insurers, and banks hold enormous amounts of these bonds as safe assets. When their value declines, obligations do not disappear. Payments must still be made. Stability must still be preserved. This is where the quiet adjustment begins. There's no dramatic announcement, no immediate crisis. Institutions simply respond. They reduce risk, they increase caution, they look for liquidity. Because Japanese institutions hold large overseas investments, these decisions ripple outward. The global system feels the change through capital flows, not headlines. Many ask why Japan would allow this to happen. The question assumes control. In reality, markets sometimes move faster than policy. Defending a currency, managing inflation pressure, and maintaining credibility can force central banks to step back. When that happens, bond prices adjust on their own. Bond math is unforgiving. When yields rise, prices fall. Balance sheets tighten. Confidence weakens. Strategies built on cheap funding start to strain. Assets priced for abundant liquidity face resistance. The cost of money begins to rise, not only in Japan, but globally. This process unfolds quietly. It drains strength before it drains confidence. Markets may still rise at times, but recoveries become weaker. Volatility becomes harder to suppress. The system feels heavier. Japan's bond market is not a side story. It is the starting point. What appears to be a local adjustment is the first movement in a global chain. As this shift continues, it reshapes liquidity, leverage, and risk everywhere. The signs are already forming. The only question is who recognizes them early. For decades, Japan played a role few fully appreciated. It did not dominate headlines, but it quietly financed them. While other economies consumed capital, Japan supplied it. When returns at home were near zero, Japanese money had no choice but to travel. It moved outward into the global system and became a silent partner in growth elsewhere. This outward flow was not ideological, it was mathematical. Japanese institutions, pension funds, insurers, banks, and investment trusts needed yield. With domestic bonds offering almost nothing, capital was pushed abroad. It bought U.S. treasuries, European debt, global equities, private funds, real estate, and infrastructure. Over time, this money became embedded in the plumbing of global markets. It supported asset prices without demanding attention. Most investors never noticed the source. They only saw the effect. This is why the concept of repatriation matters. Repatriation is not a political decision. It is not driven by headlines or emotions. It happens when incentives change. When yields at home rise and risk abroad becomes less attractive, capital does not stay loyal. It returns. And when it returns, it does not do so gently. Japanese institutions manage enormous balance sheets. Their decisions are measured, but their scale is massive. Even a small percentage shift can remove large amounts of liquidity from global markets. This is not about selling everything at once. It is about steady, persistent withdrawal. That kind of flow is far more damaging than a sudden shock. Sudden shocks trigger responses, slow drains exhaust systems. When Japanese yields rise, domestic bonds become competitive again. At the same time, falling bond prices weaken local balance sheets. Institutions face a double pressure. They see opportunity at home and risk abroad. To rebalance, they raise cash. And the fastest way to raise cash is to sell liquid foreign assets. This is where the global impact begins. Foreign stocks, bonds, and funds are easier to sell than domestic holdings tied to long-term liabilities. Profitable positions are reduced first. Winners are sold to cover losses elsewhere. This is not a judgment on the quality of the assets being sold. It is a response to balance sheet reality. Forced selling behaves differently from voluntary selling. A voluntary seller waits for price. A forced seller accepts price. When forced selling enters the market, rallies change character. Strength is sold into. Recoveries stall. Each bounce meets supply. Retail investors, conditioned to buy dips, unknowingly provide exit liquidity. This process rarely makes headlines early. Markets may move sideways for months while wealth quietly erodes. Volatility increases, but panic does not arrive immediately. This creates confusion. Many mistake the absence of a crash for stability. In reality, the system is adjusting under strain. Repatriation also affects leverage. Many global investments were built on the assumption of stable, low-cost funding. When Japanese capital withdraws, funding conditions tighten. Leverage becomes more expensive. Risk tolerance shrinks. Institutions reduce exposure not because assets suddenly became bad, but because the cost of holding them increased. Liquidity is often misunderstood as confidence. In truth, liquidity is capacity. When capacity declines, markets cannot absorb the same volume of risk. Prices must adjust to reflect this new constraint. There is also a psychological dimension. For most of the modern financial era, Japan was a net buyer of global assets. This created a tailwind. Investors grew accustomed to it without recognizing it. When a long-standing tailwind reverses, progress feels harder. Gains come slower, losses linger longer, narratives stop working. This is how repatriation reshapes markets without dramatic events. Another overlooked factor is obligation. Japanese institutions are not speculators. They manage retirement income, insurance payouts, and long-term promises. When domestic bond prices fall, they must protect their solvency. That priority overrides return seeking abroad. Survival always comes before optimization. As more capital returns home, global markets must adjust to a new reality. Liquidity that once felt permanent reveals itself as conditional. Asset prices that relied on abundant funding face resistance. Volatility becomes structural rather than episodic. This is not a temporary adjustment. It is a change in direction. Repatriation does not end quickly. It continues as long as incentives remain aligned. As long as domestic yields stay higher, hedging costs remain elevated, and balance sheets remain under pressure, the flow persists. It does not need a crisis to sustain it. It only needs math. And math does not care about sentiment. What makes this phase especially dangerous is its subtlety. There is no single moment that signals completion. There is no bell that rings. The damage accumulates slowly, then suddenly becomes obvious. By the time the broader public recognizes the shift, positioning has already changed. Japan's capital returning home is not an isolated event. It is a structural reversal of a decades-long flow. And when a system built on outward movement begins to pull inward, the consequences reach far beyond its borders. This quiet withdrawal sets the stage for the next phase, where leverage, currency dynamics, and funding structures begin to unwind under pressure. For many years, one assumption sat quietly at the center of global finance. Money would remain cheap somewhere. If it was not cheap in one country, it would be cheap in another. This belief allowed institutions to build strategies that depended less on productivity and more on access. Japan became the cornerstone of that access. The yen was not just a currency, it was a funding tool. Because interest rates in Japan stayed near zero for so long, borrowing in yen felt almost risk-free. Large institutions borrowed cheaply, converted the funds into other currencies, and invested in higher return assets across the world. Stocks, bonds, private equity, real estate, and even speculative assets were all touched by this flow. The difference between borrowing costs and returns became profit. This strategy was known as the carry trade. At first, it appeared stable. Currency movements were small. Funding costs were predictable. As long as the yen stayed weak and rates stayed low, the trade worked. Over time, leverage increased. Positions grew larger. What began as a conservative strategy evolved into a core pillar of global risk-taking. Few stopped to ask what would happen if the conditions changed. The carry trade has two hidden vulnerabilities. The first is interest rates. The second is currency strength. If borrowing costs rise or the funding currency strengthens, the math breaks quickly. Japan's shift triggered both at the same time. As Japanese yields moved higher, borrowing in yen became more expensive. At the same time, capital returning home increased demand for the currency. The yen began to strengthen. For investors who had borrowed yen, this created a problem. Their debts grew in value just as their assets faced pressure. This is when cheap money turns hostile. Leverage works quietly on the way up. On the way down, it demands action. When losses appear, institutions do not debate philosophy. They reduce exposure. They close positions. They sell assets. This process is mechanical, not emotional. Risk managers act faster than narratives. The unwind begins where liquidity is deepest. Highly liquid assets are sold first. Major stock indices, popular exchange-traded funds, large-cap equities. Anything that can be sold quickly becomes a source of cash. The selling is not targeted. It is broad. It does not discriminate between strong and weak companies. This is why markets can fall even when fundamentals appear unchanged. As the yen strengthens, the pressure intensifies. Each move higher increases the real cost of outstanding debt. Hedging becomes more expensive. What once looked like a safe spread becomes a guaranteed loss. At that point, speed matters more than price. Institutions rush to exit before conditions worsen. This creates feedback loops. Selling assets pushes prices lower. Lower prices increase volatility. Higher volatility triggers margin requirements. Margin calls for more selling. Each step reinforces the next. The system does not pause to assess value. It responds to risk. Currency markets amplify the effect. When Japanese institutions sell foreign assets, they receive foreign currency. To meet obligations at home, they convert those proceeds into yen. This conversion strengthens the yen further. A stronger yen increases pressure on remaining carry trades. More positions become unviable. More liquidation follows. This is how a funding strategy becomes a global event. The damage spreads beyond speculative corners. Even conservative portfolios feel the impact. Many long-term investments were financed or hedged using yen-based funding. When that funding becomes unstable, portfolios must be adjusted. Exposure is reduced. Risk budgets shrink. The modern financial system is deeply interconnected. Funding markets link assets that appear unrelated. A currency move in Japan can affect equity prices in the United States or credit spreads in Europe. This is not coincidence. It is structure. One of the most dangerous aspects of a carry trade unwind is confusion. Investors look for reasons tied to earnings, geopolitics, or sentiment. They struggle to explain why markets fall together. The true driver sits beneath the surface. It is not about confidence, it is about financing. When financing fails, everything else becomes secondary. This phase is often misinterpreted. Early in the unwind, markets may still rally occasionally. Liquidity has not vanished completely. Optimism returns briefly. These rallies convince many that the danger has passed. In reality, they offer opportunities for large players to reduce exposure. Each rebound becomes weaker than the last. The carry trade unwind does not announce its end. It continues until leverage is reduced to a level the new funding environment can support. That process can take months or longer. During that time, volatility remains elevated and stability feels fragile. What makes this moment especially important is scale. The yen carry trade is not a niche strategy. It is embedded in global finance. Its unwinding affects risk, assets, currencies, and funding conditions simultaneously. Japan's shift did not simply raise rates. It challenged a foundational assumption of modern markets. When the cheapest source of money in the world stops being cheap, the entire system must reprice. This is the stage where hidden stress becomes visible, and where the consequences begin to move from technical to systemic. At this stage, the story moves beyond markets and strategies. It reaches governments, balance sheets, and the structure of the global financial system itself. What began as a change in Japan, S-bond market, now presses against the foundation of sovereign debt worldwide. Japan is not just a lender to markets, it is a lender to governments. For years, Japan has been one of the largest foreign holders of U.S. government debt. This position was not symbolic, it was functional. Japanese institutions bought U.S. treasuries because they were liquid, large, and offered better returns than domestic bonds. This steady demand helped keep U.S. borrowing costs lower than they otherwise would have been. That demand was part of the system's balance. When Japan's incentives change, that balance shifts. Repatriation does not only affect stocks and funds, it affects sovereign debt markets. If Japanese buyers slow purchases or begin selling to meet domestic needs, the impact is felt immediately in Treasury auctions. Bond auctions are not abstract events, they are tests. Each auction asks a simple question: who is willing to lend at this price? And when demand weakens, prices fall. When prices fall, yields rise. Rising yields increase borrowing costs across the economy. Mortgages become more expensive. Corporate refinancing tightens. Government interest expenses grow. This is where the feedback loop forms. Higher yields increase government deficits by raising interest costs. Larger deficits require more borrowing. More borrowing increases supply. Increased supply requires more buyers. If buyers hesitate, yields rise again. The loop feeds itself. Japan's role matters because it was a reliable source of demand in this loop. When reliability weakens, the system searches for substitutes. Sometimes domestic investors step in. Sometimes other foreign buyers absorb the supply. But capacity is not unlimited, and confidence matters. When confidence weakens, policymakers face a dilemma: allow yields to rise and risk economic slowdown, financial stress, and political consequences, or intervene to stabilize markets. Intervention usually means liquidity. Liquidity means central banks expand balance sheets. They buy bonds. They inject currency. They become buyers of last resort. This process has a name: monetization. Monetization is not a conspiracy or a slogan. It is a mechanism. When the central bank buys government debt with newly created money, it changes the nature of the system. Debt is no longer disciplined by market demand alone. It is supported by currency creation. This support stabilizes markets in the short term. In the long term, it shifts risk. When more currency is created to absorb debt, the value of that currency changes. Purchasing power erodes. Nominal prices rise. Real value becomes harder to protect. This is not always visible immediately. It unfolds gradually, often unevenly. Some assets adjust faster than others. Cash and long-duration bonds suffer quietly. Their nominal value may appear stable, but their real value declines. Assets tied closely to the financial system remain vulnerable to policy decisions. This is why periods of heavy intervention often coincide with growing interest in assets outside the promise-based system. This is not driven by fear. It is driven by logic. A bond is a promise. A currency is a promise. When the system relies increasingly on intervention to function, the credibility of those promises becomes the central question. Investors do not abandon them overnight, but they begin to diversify away from them. This is how a sovereign issue becomes a global repricing. Japan's shift accelerates this process by removing a stabilizing force. It exposes how much of the system depended on continuous, predictable demand. When that demand weakens, the burden shifts to policy. Policy can delay consequences, but it cannot eliminate them. Another risk emerges here: timing. Markets rarely move in straight lines. There may be periods of calm, there may be rallies driven by intervention. These moments can feel reassuring, but they do not resolve the underlying imbalance. They manage symptoms, not causes. The cause remains structural. High debt levels limit policy choices. Rising rates increase costs. Intervention dilutes currency. Each option carries trade-offs. Over time, those trade-offs accumulate. The system becomes more fragile, not because of a single failure, but because flexibility disappears. This is why Japan's bond market matters so deeply. It forces the global system to confront limits that were previously ignored. It reveals how interconnected funding, leverage, and sovereign finance truly are. It turns abstract risks into operational ones. The final stage of this story is not defined by panic. It is defined by adjustment. Capital becomes more selective. Leverage is reduced. Liquidity is priced differently. Assets once assumed to be safe are reassessed. Decision makers begin to focus less on nominal returns and more on preserving real value. Japan did not shut down the global economy with an announcement. It did so by changing the cost of money at the margin. That margin was enough to set a chain in motion. And once that chain begins, it does not stop quietly. This is where the warning becomes clear. Systems built on assumptions last only as long as those assumptions hold. When they change, adaptation is no longer optional. It is required. The global economy is now in that phase.